Hi everyone, welcome back to our trading education series. In this lesson we'll discuss risk management. In this lesson we will discuss risk in trading and the various risks that you need to be aware of, how to manage said risk, how to utilize stop losses to limit any potential drawdowns that you may incur on your trading account and to take control of the various risks that you may encounter, and how to use trading journals to accurately document your performance over time. So, financial risk is the risk of losing capital in an investment or trade. This can be defined as the amount of money one could lose when trading or investing. Risk is not a measurement of what is actually lost in a trade or investment, but what could be potentially lost. And this is something that we want to keep in mind of as we enter and exit trades. Major part of being a successful trader is proper risk management. Managing risk involves assessing and reacting to the ever-changing market environments that appear in front of you. Arguably, it is the most important, yet least popular topic in trading education. Everyone wants to know about chart patterns and what indicators to use, but rarely do people want to discuss proper risk management, how to set up stop losses, and how to avoid blowing up an account. Now, risk management entails how to identify risk, how to gauge risk in terms of severity, little risk, it's a high risk move, how to handle and monitor risk during a trade, and how to react to risk variables, how to mitigate risk, and planning around unavoidable risks to have the best and efficient outcomes. Also, when or if to risk more or less in certain situations. Risk management is key to being a successful trader. All the technical analysis in the world will not help you if your account gets wiped out trading, or you get stuck in a position, or you get liquidated, or your account gets blown up. One of the first steps in managing risk is knowing your main goal. Know what you want to get out of the trade. And this could be summed up in a couple questions such as, what is your goal with this investment or trade? What are you looking to achieve? Are there specific numbers or target profits that you're looking to make, maybe in terms of the valuation increase or decrease on the asset, or percentage gains? What time frames are you looking for in terms of your trade? How are you basing your trade? How long are you planning on being in the trade? Realistically, we should never enter a trade or investment without knowing your objective. And that means answering these questions or having a clear conception of these questions and how you will respond to someone asking you, or really asking yourself, having a clear idea of all of these parameters for your trade entry. Now, a big part of risk management is identifying potential risk. What could happen to your trade or investment to go poorly? What factors could come into play that could cause these events to happen, or to cause your trade idea to go backwards or to fail? And also, in terms of risk assessment, what are the chances of the assumed risk that it could play out? How likely is the trade to go in your favor? Are the chances of the trade not going in your favor higher than the chances of it going according to plan? How severe are these risks? Once again, no one trades 100% accurately all the time. So being able to identify potential risk and identify the chances of your trade idea playing out accurately to what you intend for it to do, being able to assess that is critical to becoming a successful trader over time. We also want to consider how we respond to risks in the market. This can include asking yourself, what are your plans in case an unfavorable event happens? Do you have a stop loss set? How are you accounting for that specific risk? Let's say you're buying Bitcoin and it's $45,000 and you want it to go to 50, and you did your research, you charted out your lines, and your indicators are telling you enter, now it's the time to buy. You enter. Now, what are your plans in case an unfavorable event occurs? What if the Federal Reserve announces that they're stopping bond purchases and they're raising the interest rates? That's going to have a negative effect on all financial markets. So having a stop loss in place for those particular moments that are completely out of your control is key to not only saving your account, but avoiding being stuck and taking worse losses than you normally would. We also want to monitor our strategy over time. Successful risk management strategies can take time to develop, along with many instances of trial and error. Different market environments may call for different risk management strategies. The only way to improve and learn risk management is through monitoring how well your plan works in a given scenario, collecting that data, and analyzing it subjectively, what went wrong and what went well, and how you can improve and use that information to better yourself for the next time. So one of the first types of risk we'll talk about is market risk. So market risk is risk corresponding with the fluctuating price of an asset. An example of this could be found where, let's say Drew is a trader, he buys Bitcoin, he's taking on market risk due to market volatility that could cause the price to drop. Bitcoin and really cryptocurrency in general is notorious for its market volatility. It goes up, it goes down, it fluctuates very frequently. And by purchasing that, you are taking on that risk that due to volatility, the price could fall. This is considered a direct risk where Drew purchases Bitcoin before a price drop. Now, an indirect market risk pertains to an asset with a secondary or a correlated risk. Now, this could be in the form of interest rates affecting the price of stocks and crypto indirectly. So it's not necessarily something, the actual asset itself fluctuating in price. It could be something that has a causation on the effect. It has a direct effect on the asset itself, or on the market, on the sector, or on overall general financial stability. This could be in the format of war, possibly, or interest rates being increased by the Federal Reserve or central banks. And we see this where lower rates encourage companies or groups to take on debt, increasing overall capital for further investments. And higher rates encourage investors to sell these investments to pay their debts. Higher interest rates means taking on debt becomes much more costly to maintain, and it's not encouraged, essentially. Lower rates means it's easier to take out those loans, and the capital becomes much more liquid, and it's easier to acquire said capital. Global macro financial factors can also be considered, such as war, pandemics, and more. Now, a major type of risk that sometimes is not spoken of as frequently as market risk or other types is liquidity risk. Liquidity risk pertains to risks traders take on when trading in illiquid markets. So liquidity is the ability to sell or buy an asset without having a major effect on market prices. It's also a measurement of the amount of buyers or sellers in a market where a liquid market has a smaller bid-ask spread, meaning that there's more people buying and selling in that market, and the latest asking price and the latest selling price are very close to one another. Now imagine Drew wanted to buy $5,000 worth of a crypto at $50 each. In a liquid market, Drew would be able to buy most, if not all, of his desired coin at that target price of $50, exactly $50, since sellers are plentiful. There's a lot of people in the market participating, and there's a lot of people wanting to sell their coin at $50 each. Now, in an illiquid market, Drew may find issues finding enough sellers posting sell orders at that $50 per coin. Drew might have to spend more per coin on average, since there's just less people selling at that particular price. Now, it's important to remember, markets are not, when you're trading on an exchange, you're not just trading between yourself and the exchange. You're not just buying coins directly from Coinbase, or you're selling coins to Coinbase. There's another person on the other side of that transaction who has opted and agreed to buy or sell that coin at the price that you both have determined. So if Drew wants to buy $5,000 worth of a coin, of a token, at $50 each, there needs to be somebody on the other side of that transaction that wants to sell him those coins at that price. Now here's an example of Bitcoin to US dollar. This is found on Coinbase. This is an example of a highly liquid market, meaning that there's a lot of participants and it's easy to get a specific price that you may want of that coin. As you can see here, here's a rundown of the prices. This goes in spaces of $5 each, of increments of 5. And here we see the various position sizes, the market sizes of pertaining to each price. So like at $47,595, there's 3.7292 Bitcoin being sold. At the 47,600, there's 1.12 Bitcoin being offered for sale. At $47,605, we see 4.15 Bitcoin being offered for sale at these prices. So there's a lot of liquidity in this market. Bitcoin is considered the most liquid market in terms of the greater cryptocurrency markets. It sees the highest trading volume, and there's the most amount of participants and most amount of money being exchanged compared to others, with Ethereum being the second. In the green, we also see the buys, and we also see here there's a significant amount of people and buy orders placed along these $5 increments as well. So there's a lot of people at each one of these price levels trying to buy or sell. Now this is contrasted in an illiquid market, where we see here, this is actually the Smartlands to XLM order book. This is found on the Lobster wallet. This is a wallet and a trading platform that is on the Stellar network. Using the Lobster wallet, you can actually exchange and trade your XLM for a variety of coins, including Smartlands. We won't get too much into the details of Smartlands. Smartlands is a low market cap coin. It mainly focuses on real estate management and real estate digitization using NFT technology. Here we see the order book, where let's say we want to buy Smartlands. We see the price measured out in XLM, and we see the amount of SLT, Smartlands, offered. Here we see a variety of different prices. From the highest buy would be 26.53 XLM, and then 26.53 725 2635, 2653, and then a jump to 2637 XLM, then 2613, 2612, 2610. So we see a much bigger price differential compared to Bitcoin, where there was a significant amount of Bitcoin being sold at each one of those $5 increments. We also see the amount of SLT really varies. Particularly here at 0.74 SLT being sold, 9 SLT being sold at 26, 13, 0.00001, 246 being sold at 2613. So we can consider this to be a significant sell wall or buy wall. On the other side, looking at the sell side, we see the same thing as well, where there's these large price gaps. Here, the lowest sell 26.97, 3.46 SLT is offered, then the next 2702, and then it jumps to 2722. So there's once again a large price differential between each one of these levels, between buyers and sellers, and there's gaps between it. It's inconsistent in terms of how much is being offered, how much is being sold. We also see that reflected in the history as well.